Welcome to Nifty Indicators. It's easy to make money. Yesterday we saw the different type or various aspects of options, various factors that are affecting the options. Today we will look at one of the most important aspect. But then before going to that, let me clarify. Most of us retail traders, especially the beginners, should not really worry about option Greeks. Option Greeks doesn't really come into day-to-day working of a retail trader. It should not really worry us. Whereas now what we are going to, implied volatility is an important aspect. Implied volatility is not a fixed percentage or anything. We can always calculate what is the implied volatility of a particular option by using the volatility computer provided by our brokers. First, we will see the PPT and then we will discuss it a little more in depth. Implied volatility is a very important aspect of trading. Implied volatility is an essential ingredient to the option pricing. It represents the expected volatility of an underlying over the life of the option. It is directly influenced by the supply and demand of the underlying options and by the market's expectation of the underlying direction. As expectations rise or as the demand for an option increases, implied volatility will rise. The rise and fall of IV will determine how expensive or cheap time value is to the option. This is the IV calculator. We can compute the IV if we have the other parameters available, or if we have the IV available with other parameters, we can try to calculate what the price should be. In this particular case, we can see here IV being calculated. It is given. It is today's 17,100 call at the closing 3:30 p.m. on 14th of October 2022. 17,100 call was costing 201 rupee at 3:30 p.m. The stock price, that is Nifty, was at 17,185.70. Strike price of 17,100 call. That is 17,100 is the strike price. Dividend percent per annum is normally 25%. Interest rate normally is taken as 12%. Duration left, that is the days left till the expiry, it is next week's expiry, so 6 days left. Option type is call and exercise type is European. Of course, there are European and American type, and in India, in Indian markets, we use European type. So, by feeding all these information, we can ask the calculator to compute the volatility, and it will compute and show us that the volatility of IV of this particular call at this particular price is 15.35. Now, let us discuss it in a little in depth, deeper. For that, each listed option has a unique sensitivity to IV changes. For example, a short dated option will be less sensitive to IV, while long dated option will be more sensitive. This is based on the fact that long dated options have more time value priced in, while short dated options have less time. IV is expressed in a percentage term and is relative to the underlying stock and how volatile it is. Buy undervalued options and sell overvalued options because premium built-in is high in overvalued option and premium is less in undervalued option. Evaluating and forecasting IV will be making buying cheap, that is cheap options, and selling expensive options easier. When options are trading with high IV levels, sell options. When options are trading with the low IV levels, buy options. Normally, an option buyer should look to buy the options as close as 8% implied volatility as possible. Higher the implied volatility, lesser chances of the option buyer's gains. These days, IV is very high. IV, as you saw in the IV computation table or IV calculator, without that being any major event or anything, on a Friday evening, IV of 17,100 call stands at 15.1%. That is very high or quite high because it very high goes to 23%, 25%, 30%, etc., etc. It depends on whether there is a. So normally, if there is an event forthcoming tomorrow, if it's a budget session, or tomorrow if it is RBI MPC decision day, or tonight or tomorrow is a Fed decision day, etc., etc. If there is important event or election result, etc. If there is an important event that might make the underlying or the index fluctuate widely, volatility increases, and because of that, implied volatility of the options is going to increase. So we need to be careful when we are buying options to see what is the IV, because normally what happens is, say for example, if we take RBI decision day, the earlier day, the day before or on the eve of the MPC decision, IV could be as high as 25-30%, whereas on the IV day, on the RBI MPC decision day, the IV could be 15, 20, 25%, whereas after the decision is made, after the press conference is finished and the event is over, the IV might come down to 15, 12, etc. Normally, it is healthy to buy any option as close to 8% IV as possible. Tomorrow, we will take up a little more important aspect of options. Till then, goodbye. Take care. God bless you.